Today we are going to do a breakdown case analysis for our company, Coca-Cola. My name is McKenna Riley.
I'm Yokai Everingham.
And I'm Valerie Miller.
Let's get started. So we're first going to begin with an analysis based on modules 2 through 6, starting with net working capital. For 3 years, the company's net working capital is $2,867 million, $2,595 million, and $4,639 million, respectively. Largest asset was goodwill. The amount of goodwill is $18,782 million in the first year, $19,363 million in the second, and $17,506 million in the third year. Their largest liability was long-term debt. That was $36,377 million in the first year, $38,116 million in the second, and $40,125 million in the third year. Percent assets financed. In the 3 years, the company is financing a decreasing percentage of assets through owners and an increasing percentage through non-owners. Their largest expense amount is $18,000 million in the first year, $15,357 million in the second year, and $13,433 million in the third year.
Net income. In all 3 years, cash flows from operations are greater than net income, indicating positive cash generation. Cash flow from investing. Capital expenditures exceeds depreciation in all 3 years, suggesting investments in new assets. Cash flows from financing. The company is financing its activities with negative cash flows from financing in all 3 years, which may indicate borrowing or equity issuances. Book value and market value. Market value is greater than book value in all 3 years, indicating that the market values the company is higher than its stated equity. Cash flows from operations. In the first year, the company generated $11,080 million in cash from its core business operations. In the second year, the cash flow from operations increased to $12,625 million. And in the third year, it decreased to $9,844 million. Cash flow from investing. Cash flow from investing. In the first year, the company had an cash outflow of $763 million, indicating investments in assets. In the second year, the outflow increased to $2,765 million. And in the third year, the outflow was $1,477 million. Capital expenditures. In the first year, CapEx was $1,409 million. In the second year, it decreased to $1,259 million. And in the third year, it was $988 million. CapEx represents investments in plant, property, and equipment. Cash flow from financing. Cash flow in the first year had an outflow of $10,250 million from financing activities. In the second year, the outflow decreased to $6,786 million. And in the third year, it was $8,070 million.
Then, as we moved into new debt issued, in the first year, the company issued a little less than $4,000 million in new debt. In the second year, the amount increased to a little more than $13,000 million. And in the third year, it further increased to $24,934 million. Then we moved along to debt repaid. The first year, the company repaid close to $5,000 million in debt. In the second year, the amount increased to $12,866 million. And in the third year, it significantly increased to $28,796 million. As we moved along to new stock issued, in the first year, the company issued $837 million in new stock. The second year, the amount increased to $702 million. And in the third year, it was $647 million. And then as we move along to stock repurchased, in the first year, the company repurchased $1,418 million in stock. The second year, the amount was 111 million, and in the third year, it was 118 million. Dividends paid represent the cash flows to shareholders. In the first year, the company paid out $7,616 million in dividends. In the second year, the amount was $7,252 million, and in the third year, it was $7,047 million. And finally, the end of fiscal year share price. This indicates the company's stock price at the end of the fiscal year. In the first year, the share price was $63.61 in millions. In the second year, it was 59.21, and in the third year, it decreased to 54.84. These figures provide a comprehensive view of the company's cash flows and financing activities over the 3 years, showing how it managed its capital, debt, and stock transactions. And as we move along to the next slide, these financial metrics provide insights into the company's profitability, asset management, leverage, and liquidity over the 3 years. The net profit after tax represents the profit generated from the operations after accounting for taxes. The first year, that was $6,340 million, which was the highest among the 3 years. It decreased to $5,078 million in the second year, and further to $4,969 million in the third year. Our net operating profit margin is the percentage of operating profit relative to total revenue. It was 14.74% in the first year, and that decreased to 13.14% in the second year, and then increased to 15.5% in the third year. For net operating profit margin, the net operating asset turnover, NOAT measures how effectively assets are used to generate operating profit. Is relatively low, indicating that assets were not efficiently used for generating profit. Then we have our return on assets. RONA indicates the return generated from operating assets. It was low, ranging from 0.10% to 0.12%, suggesting that the company's operating assets were not highly profitable. And then the return on equity. This represents the return generated shareholders' equity. It was low, ranging from 0.37 to 0.42, indicating lower returns for shareholders. Then the DuPont profit margin measures the profitability of the company's operations. It was low, decreasing from 25.28% to 22.19%, and then increasing to 23.47%. And then we have our DuPont asset turnover, which measures the efficiency of asset utilization. It was relatively high in the first year, but decreased in the subsequent years. DuPont financial leverage measures the degree of financial leverage. It increased over the years, indicating higher financial leverage. The DuPont return on equity represents the overall return on equity based on the DuPont analysis. It was relatively high in the second year, but decreased in the third year. And then our return on assets measures the return generated from the company's total assets. It was low, ranging from 8.92% to 10.76%.
Okay, moving on to our next slide, our current ratio. It measures the liquidity and the company's ability to cover short-term liabilities. In this case, it was relatively high, ranging from 1.13 to 1.32. Quick ratio is the ratio that is more stringent. It measures of liquidity as it excludes inventory. It was low, ranging from 0.93 to 1.09. Liabilities over equity. This ratio measures the extent to which a company is financed by debt relative to equity. It was relatively high, ranging from 2.78 to 3.42 times interest earned. This ratio assesses the company's ability to cover interest expenses. It was relatively high, indicating a strong ability to cover interest expenses. These metrics provide a comprehensive view of the company's financial health and performance, including a profitability, asset management, leverage, and liquidity. Moving on to net operating assets. The NOA represents the total assets that are directly related to the company's core operating activities. In the first year, the NOA was $65,639 million. In the second year, it increased to $67,798 million. And in the third year, it decreased to $64,998 million. The average net operating asset is the mean value of the NOA over 3 years. It was approximately $66,719 million. Net operating obligations represent the obligations or liabilities that are not related to the cooperating activities of the company. In the first year, the NNO was $35,874 million. In the second year, it increased to $39,657 million. And in the third year, it further increased to $43,031 million. The average NNO is the average value over the 3 years, and it was approximately $37,766 million. Okay, moving on to the pre-tax net operating expense. This is the net expense incurred by the company on non-operating activities before taxes. In the first year, the NNE was $777 million. In the second year, it increased to $2,117 million. And in the third year, it decreased to $752 million. The average total assets, this represents the mean value of the company's total assets over the 3 years. It was approximately $93,559 million. These metrics help in assessing the company's operating assets, non-operating obligations, and the overall financial structure. Changes in these values over time can provide insights into the company's financial management and performance. Okay, moving on to the return on equity. This is a measure of how efficiently the company generates profits from shareholders' equity. It is low, ranging from 0.37% to 0.42%. Indicating relatively lower returns on equity. Return on assets measures the company's ability to generate profits from its total assets. It is low, ranging from 0.09% to 0.11%, suggesting less effective use of assets to generate profits. And kind of hidden a little bit, but return on operating assets assesses the return generated from operating assets. It is low, ranging from 0.1% to 0.12%, indicating limited profitability from operating assets. On our next slide, we will look at times interest earned. This ratio measures the company's ability to cover interest expenses. It is relatively high, indicating a strong ability to cover interest expenses. Operating cash flow to debt. This metric shows the proportion of operating cash flow relative to total debt. It is low, ranging from 0.122 to 0.141, indicating potential challenges in generating sufficient cash to cover debt. Free cash flow to debt. This measures the company's ability to repay debt with available free cash flow. It is low, ranging from 0.11 to 0.127, suggesting limitations in using free cash flow to repay debt. Current ratio. This assesses the company's short-term liquidity and ability to meet short-term obligations. It's relatively high, indicating good short-term liquidity. Quick ratio. As a more stricter measure of short-term liquidity, as it excludes inventory, it is low, suggesting that the company's liquidity may be impacted when excluding inventory. Liabilities over equity. This ratio measures the financial leverage, indicating how much debt the company uses relative to equity. It is low, suggesting relatively high financial leverage. Total debt to equity ratio. This ratio provides a view of the company's overall debt in relation to equity. It is relatively low, indicating lower debt levels relative to equity. Credit ratings. The company has received credit ratings from two credit agencies, Moody's and S&P. Both ratings are in the high category, suggesting a strong creditworthiness. You want to invest in these guys. The Altman Z scores are relatively high, indicating a low risk of bankruptcy. Coca-Cola. Days payables outstanding is relatively high, indicating that the company takes longer to pay its suppliers. Capital expenditures is the amount spent on capital investments, and it ranged from $595 million to $1,475 million over the years. Common shares outstanding. The number of shares outstanding remained relatively stable over the 3 years. The Z score for the common shares outstanding. Anyway, moving on. Let's see here. So my next slide, looking at research and development. These expenses were not provided, indicating that the company's R&D expenses are not available. Let's see here. I will move on to allowances for doubtful debts. The allowance remained constant at $560 million over 3 years. Allowance relative to gross accounts receivables. This increased over the years from 14.8% to 16.41%. This suggests that the company set a high proportion of its accounts receivable for potential bad debt. Bad debt expense, it was $6,363 million in the first year, $5,679 million, and $5,418 million respectively. Relative size of bad debt to gross accounts receivables. This increased over the years from 1.825 to 1.723. This indicates a higher provision for bad debt relative to accounts receivables. Accounts receivable turnover. This metric is relatively high, ranging from 5.359 to 6.998. A higher turnover implies that the company collects its accounts receivables more efficiently. Days sales outstanding. This measures how long it takes on average for the company to collect its accounts receivables. It increased from 52 days to 68 days, indicating a slight delay in receivables collections. Restructuring expenses. These metrics are not provided. Okay. Current tax expense was $2,237 million, $1,727 million, and $1,999 million respectively. The deferred tax expenses was negative $122 million in the first year, then it increased to $894 million in the second year, and then decreased to negative $18 million respectively. Effective tax rate. This tax ranges from 18.1% to 21.1%, with a decrease to 20.3% in the third year. This represents the company's actual tax rate applied to its earnings.
Now we are going to move on to inventory method. Most of this information is from Module 6, and it provides information related to inventory methods, inventory composition, inventory turnover, inventory days, cash conversion cycle, gross margin percentage, property, plant, and equipment metrics, and depreciation details. So, inventory method. The company uses the FIFO, first in, first out method for inventory valuation consistently over the 3 years. Raw materials inventory as a percentage of total inventory. The percentage of raw materials in total inventory decreased slightly over the years from 62.060% to 64.483%. Work in process inventory percentage. Data for work in process inventory percentage is not available, indicating that the data set lacks this information. Finished goods inventory percentage. The percentage of finished goods in total inventory decreased over the years from 29.459% to 24.219%. Inventory turnover. Inventory turnover is relatively high, ranging from 4.043 to 4.708. A higher turnover suggests efficient management of inventory. Average inventory days. The average number of inventory days increased from 77.532 to 90.279 days, indicating a longer inventory holding period. Cash conversion cycle. The cash conversion cycle increased over the years from 38.684 days to 44.618 days. A longer cycle indicates a slower cash turnover. Gross margin percentage. The gross margin percentage decreased slightly over the years, ranging from 58.143% to 60.272%. PPE, or property, plant, and equipment, as a percentage of total assets. The percentage of PPE in total assets increased from 12.124% to 14.119%. This indicates a higher investment in fixed assets. Depreciation policy used. The company consistently uses the straight line depreciation method for its assets. Relative size of PPE. The relative size of PPE increased over the years from 10.51% to 12.35%, suggesting a larger investment in property, plant, and equipment. PPE acquired. The company acquired $385 million worth of PPE, had a disposal of $2,586 million and $863 million in PPE over the last 3 years, respectively. PPE turnover, or PPET, is relatively high, ranging from 9.704 to 21.363. A higher turnover indicates efficient utilization of fixed assets. Average useful life of assets. The average useful life of assets remained consistent at 2 years. Assets used up. The percentage of assets used up increased slightly over the last 3 years from 60.91% to 64.79%. And lastly, bad debt expense. The previously mentioned bad debt expense are reiterated here.
Okay, we're going to do a brief review of the financial statements. Net working capital increased over the years. This indicates an increase in the company's short-term liquidity. As stated before, the largest asset was goodwill. Goodwill represents intangible assets such as brand, value, reputation, and customer relations. As stated before, the largest liability is long-term debt. Long-term debt represents the company's long-term financial obligations. Let's see here. The largest expense is cost of goods sold over the 3 years, with values of $18 million, $15,357 million, and $13,433 million, respectively. This expense represents the cost of producing goods or services sold by Coca-Cola, in our case, Coca-Cola. Net income decreased from $952 million to $747 million over the 3 years. Cash flows. Cash flows from investing shows negative values, indicating investments in assets or acquisitions. Capital expenditures, as stated before, are greater than depreciation over the 3 years. New debt was issued and debt was repaid over the 3 years. New stock was issued and stock was repurchased. Book value for the company decreased over the years. Excuse me. The market value of the company, however, increased over the 3 years. This indicates a market capitalization premium. Let's see here. End of fiscal year share price. This decreased from $63.61 to $58.84 over the 3 years. Moving on to profitability analysis. We're going to analyze how profitable Coca-Cola was over the 3 years. The net operating profit after tax, this decreased, indicating a decline in the company's operating profit. The net operating profit margin, this increased, suggesting an improvement in profitability, which is good. Net operating asset turnover, this decreased, indicating that the company's assets were less effective at generating revenue. Return on operating assets, this remained relatively stable. This indicates consistent return on the company's operating assets. Return on equity shows moderate returns for shareholders over the 3 years. The DuPont margin was relatively high, but it showed a slight decrease over the 3 years. The DuPont asset turnover indicates some fluctuations in asset efficiency. The DuPont financial leverage, this increased from 3.97 to 4.54, suggesting higher reliance on debt financing. The DuPont return on equity was relatively high, but it showed some fluctuations. Return on asset ratio ranged from 8.92% to 10.76%. This indicates the company's ability to generate returns on assets. Overall, the company showed a mix of improving profitability and consistent return on equity and assets. However, the decline in the NOAT and an increase in the financial leverage suggest potential challenges in asset efficiency and higher reliance on debt.
Then we move into the liquidity and solvency analysis. Based on analysis, Coca-Cola maintained an appropriate level of liquidity and has made improvements in its solvency over the years. Both the company's liquidity and solvency are well managed, similar to its current capital structure. In reference to Coca-Cola's quick ratios, in 2022 it was 3.356, and in 2021 it was 3.598, which we can determine that the company is slightly less liquid in 2022. With the decreasing liabilities, equity, and total debt equity ratios, we see that solvency has improved over that same period. Into our next slide, issues related to revenue recognition. Revenue recognition is the largest item on the income statement and is assessed on a quantitative and qualitative basis. Our team utilized horizontal analysis to identify time trends and concluded that allowance for doubtful accounts remained consistent, while other areas like days sales outstanding decreased from 68 to 53 to 52 for the current year. Accounts receivable turnover increased from 5.359 to 6.846, and finally 6.998. The numbers fluctuate in bad debt expenses, relative size of bad debt expense to gross accounts receivable, and allowance relative to gross accounts receivable. And then we have a look at our issues related to asset recognition. Since tangible assets have significant value, Coca-Cola uses a straight line method throughout the lifespan of their assets. In 2022, Coca-Cola's tangible assets were $9,841 million, which was a decrease from 2021, which was at $9,920 million, and even more from 2020, which was at $10,777 million. Larger tangible assets amounts means lighter liquidation ability. Coca-Cola's decreased tangible assets during the year are expected to continue that same pattern due to selling PPE to have cash to use towards other projects. The company's impaired asset charge is $57 million, and other temporary impaired asset charge was $96 million. In 2021, Coca-Cola only had impairment at $78 million, which means they had a daily large decrease in tangible asset impairment costs.
Next, we're going to look at a reflection on Coca-Cola's analysis from 2022. Coca-Cola's equity analysis was done by Garrett Nelson with CFRA. The analysts use absolute valuation when analyzing Coca-Cola. There is a sub-industry section that breaks down the overall industry, but this analysis is specifically regarding Coca-Cola's information over time and does not involve any other company to compare it to in this analysis. It takes all of Coca-Cola's information and compares it to itself so that you can see the growth within the company alone. Nelson's 12-month target price for Coca-Cola was $68. A target price is a company's predicted price of stock. In Coca-Cola's case, Nelson had predicted the price of stock in the next year to be $68. The current stock price, per the analysis, is $52.89. This means that Nelson is predicting a $15.11 increase in stock price. If we follow our usual ROI process and formula using this target price of $68, we can expect to make $1,511. Thank you so much for listening to our presentation. We hope all of you have a fabulous evening.